Have you ever looked at the stock market and just wondered why? Why do some companies seem to mint money for their investors while others just crash and burn? It's a huge mystery. Well, today, we're going to open up the investor's detective kit and figure out exactly how to crack that case.
And just look at the difference here. On one side, you have a company like Eicher Motors. It delivered a mind-blowing 104% compound annual growth rate for years. Just incredible wealth creation. And on the other side, a company like Suzlon Energy, a negative 30% CAGR. Total wealth destruction. The outcomes couldn't be more different. And it's our job to find out why.
So what is the secret? How can you spot the next big winner? And, maybe more importantly, how do you avoid the disasters? That's the million-dollar question, isn't it? And it's exactly what we're going to get into.
To solve any mystery, every good detective needs a method, a reliable set of tools. For us, as investors, our number one tool is something called fundamental analysis. This is how we're going to look past all the market noise and get to the real story of a business.
And you know, this is such a key idea. Fundamental analysis isn't about watching the little squiggly lines on a chart all day. No, it's a deep dive. It's for the long-term investor who understands that a stock isn't just a ticker symbol, it's a tiny piece of ownership in a real, breathing business.
Now, let's be super clear. This patient detective work is a world away from its cousin, technical analysis. Technical analysts are more like fast-paced traders. They're looking at charts, trying to guess where the price is going next. We're asking a totally different, and I think, a much bigger question. What is this business actually worth?
Okay, so having the right tool is one thing, but you gotta have the right mindset to use it properly. Because how you show up to the market, whether you're a speculator, a trader, or a true investor, that changes everything.
So let's paint a picture. Let's say there's some big news coming from the central bank. Sunil, our speculator, he's just placing a bet. It's basically a coin flip for him. Then you have Tarun, the trader. He's got a strategy to make money off the chaos, no matter which way the news goes. But Garish, the investor, he sees all this as just noise. He's busy thinking about whether the company is still going to be a great business 10 years from now.
And you can almost feel the difference in their blood pressure, can't you? There's that anxious energy of the speculator, the intense focus of the trader, and then the calm patience of the investor. Fundamental analysis, that is the chosen tool of the patient investor.
Now, don't let any of this sound intimidating. Seriously, this isn't some secret language only for Wall Street geniuses. The truth is, if you've got some common sense, you can handle basic math, and you have a little bit of business sense, you have everything you need to get started.
Okay, so we've got our method and we've got our mindset. Now, where do we actually start digging for evidence? Well, we go straight to the company's official records, its financial statements. You can think of these as the official health report for the business.
There are three main documents that we've really got to pay attention to. The profit and loss statement, which basically asks, is this company making any money? Then there's the balance sheet. It's a snapshot in time of what the company owns versus what it owes. And finally, the cash flow statement, which is so important because it shows you where the actual cash is coming from and where it's going.
I know, at first glance, a balance sheet can look like a terrifying wall of numbers, but don't let it scare you. All it's really doing is creating two simple lists. One side lists everything the company owns, and the other side lists everything it owes. It's just a financial checkup on one particular day.
So, reading through endless pages of financial reports can be, well, a bit much. The real detective work is about finding the hidden clues inside all that data. And for that, we use special tools called financial ratios. They help us make sense of it all.
And if there is one superstar ratio that you're going to hear about all the time, it's the price-to-earnings ratio. You'll hear people call it the PE ratio. It is probably the most popular way to get a quick feel for a company's valuation.
So what does the PE ratio actually do? Well, it connects the dots. It compares the company's stock price to how much profit it's actually making. If you see a really high PE, it suggests investors are willing to pay a lot for those earnings, which might mean the stock is overvalued. A low PE, on the other hand, that could mean you've stumbled upon a bargain. For example, take HDFC Bank. Its PE ratio is 21. Now, that number by itself, it doesn't mean much, does it? But an analyst would take that 21 and compare it. How does it stack up against other banks? How does it compare to the market overall? That's when the number starts telling you a story.
So, finding a company that makes money and seems to be at a decent price, that's a good start. But the final verdict, the real key to finding a truly spectacular long-term investment, is finding a company that has a durable, long-lasting competitive advantage.
Warren Buffett has the perfect analogy for this. He's not just looking for any old economic castle. He's looking for a castle that has a wide, deep moat all around it, protecting it from would-be attackers. That moat, that's the competitive advantage.
So an economic moat is that special thing that lets a company fight off its rivals and keep raking in high profits year after year after year. It's the secret ingredient that turns a good business into a truly great long-term investment.
And these moats, they come in all shapes and sizes. It could be a super powerful brand like Disney, something people know and trust. It could be a massive cost advantage, or even patents and licenses that literally block competitors from entering the game. It could even be something like high switching costs, where it's just too much of a hassle for customers to leave, or a powerful network effect like Google's search engine that just gets stronger the more people use it.
But wait, there's one final twist in our investigation. You can do all the work, find an amazing company with a giant economic moat, and you can still make a bad investment if you pay too much. That is why the best detectives always build in a margin of safety.
Because that's what it all comes down to. The whole point of this investigation isn't just to find a wonderful business. It's to figure out what that business is truly worth so you can buy it for less. That discount, that's your margin of safety. So the ultimate question you have to ask yourself isn't just, is this a great company? It's, at what price does this great company become a true bargain?